What is an index fund? An index fund is a type of mutual fund or exchange-traded fund, or ETF, that attempts to copy a specific group of investments, called an index. Think of an index like a snapshot. It shows how a group of companies is performing over time, like the FTSE 100, which represents the 100 largest companies on the UK stock market. So an index fund that follows the FTSE 100 will try to invest in all those companies in the same proportion and nothing more. It doesn't try to beat the market, it just mirrors it. Why does it matter? Index funds are popular because they're simple, low cost and easy to understand. Instead of paying someone to pick and choose investments, you just follow the index, like a preset recipe. That means lower fees, which helps your money grow faster over time. And because you're investing across lots of companies at once, your money is spread out, which can reduce risk. They're great for beginners because they don't require much effort to manage. Just pick an index and stick with it. Here's a simple example. Imagine you invest £100 in an index fund that follows the FTSE 100. That money is automatically spread across companies like Tesco, Unilever, BP, and HSBC, the same way they appear in the index. If those companies grow in value, so does your investment. If the market dips, your fund will too. But over the long term, stock markets tend to rise, and so can your returns. So rather than guessing which company will do well, you're buying a slice of the whole market. There are also global index funds that invest in companies from all over the world, including the US, Europe, and Asia. That means even more diversification. Just like other funds, you don't directly own the individual companies, but you do own a share of the fund, which itself owns the shares. What else should you know? Index funds usually aim for capital growth. That's the increase in value over time. Some also pay out income, like dividends, depending on the shares they hold. You can often choose whether to have those dividends paid out to you or reinvested, which can help your investment grow even more over time. This is where you'll see the terms DIST and ACC on a fund. DIST is short for distribution. If you choose this version of a fund, any income the fund earns, like dividends, gets paid out to you. You can use that money however you like, whether that's spending it or moving it somewhere else. ACC is short for accumulation. Instead of paying out the income, the fund automatically reinvests it back into the fund. This helps grow your investment over time because you're earning returns on a growing amount, sometimes called compounding. To put it simply, if you want to take the income, choose the DIST version. If you don't need the income and prefer it was reinvesting automatically, choose the ACC version. Both types hold the same investments, it's just about what happens to the income they generate. Because they're passive, meaning no one is actively picking stocks, they usually charge much lower fees than traditional mutual funds. You can buy them through an investing platform, inside an ISA, pension, or even set up a regular monthly direct debit to invest gradually over time. They're also available as ETFs, which are index funds that you can buy and sell on the stock market, just like shares. And while index funds give you instant diversification, they still carry risk. If the whole market falls, your fund will too. That's why they're best suited for long-term investing. Think years, not weeks. To sum it all up, an index fund is a simple, low-cost way to invest in a whole group of companies by copying a list like the FTSE 100. You get instant diversification, lower fees, and a strategy that works quietly in the background. It's a popular choice for beginners and for anyone who believes in slow, steady growth over time. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.